All right, Rusty. Well, it's good to finally get a chance to speak with you and have you on the platform. We've talked about this for about a year, maybe or so.
It does go back a way. I think it was in Charleston we first talked about it.
I think so. I think so. Yeah, we talked about it, and that's when we were in our infancy stage of our podcast. So you probably waited until we had a couple of more viewers and subscribers just to make sure that this was a quality show for you to be on. So
Oh, no doubt.
I'm really, really excited for you to be here.
Well, I'm excited to be here as well, Mel. This should be a lot of fun.
Before I get started, I just want to make sure that everyone knows who I'm speaking with. So I'm speaking with Rusty Vanneman, and I'd love for you to just kind of, instead of me doing a bio on you, I'd love for you to tell everyone who you are and really because you have a really unique and cool story. So just tell us who you are, and we'll start from there.
Awesome. Well, I'll try to make this long story short. I mean, I've been in the industry of like 35 years. So my first job was cold calling for Lehman Brothers back in the 80s. So it goes back a ways. But I'm from a small town in Nebraska. I went to school in the Boston area at a school called Babson College. I've been interested in investment management from college days, and that's basically what I've spent my whole career in. I worked in the Boston area for basically most of my career until I came back home to Nebraska. And I've been working for a firm called CLS Investments that became Orion. And I recently left there. I'm now the chairman of the advisory board for Main Management. In terms of what I've done, I've really done a lot of different things in investment management. I've been a portfolio manager. I have been a chief investment officer. I have been a chief investment strategist. I've spent most of my time really in those first two roles, managing portfolios and also managing teams. And as a CIO, for the most part of the last 20 years, that means I've been managing the team, managing the portfolios, and managing all the messages that we've had with all of our clients. So that's a little bit about it. The only other thing that's probably interesting about the career is a year after college, I did actually work on a cattle ranch.
Really?
Yeah, so it totally makes sense to be in investment management, right?
I think at some point we're all wrangling our clients at some point or another. So you had a good start in the beginning.
Exactly. Those were good skills to have.
So cold calling at Lehman Brothers, how was that?
I mean, it was straight out of the movies now, the way people look at it. I mean, I wouldn't say it was a Wolf of Wall Street environment. I mean, it wasn't
Okay.
like that because it was all blue chips and stuff like that. But I mean, we were in a bullpen surrounded by teller rates, big screens all around us, and people were on the phone, screaming orders. And my job was really, and I did this for free, is I basically cold called finding leads for some of the established brokers because I thought it looked great on my resume.
Hmm.
I think it did. I mean, it actually kind of got everything in motion. But yeah, but that's how I started.
That's interesting. So I had my start in the same field as well. Well, in the same area. So I was a marketing assistant for a financial advisor. This is an old company. The first company I worked with out of college called Northwestern Mutual. I'm sure you're familiar with who they are.
Absolutely.
And so the title was marketing assistant, but in reality, it was a cold caller. So I would make 300 cold calls a day and just dial and smile, dial and smile. And for some reason or another, I fell in love with the business, just from smiling and dialing, just getting those quality conversations. And that really, after about 6 months, 7 months, I moved into their program to the training program to become an advisor. But yeah, I got my foot in the door by smiling and dialing.
Yeah, yeah. That's where most of us got started back in the day.
Well, when what I wanted to talk to us about today was behavioral finance, and that's really the how I've known you when we first met with when you were at Orion.
Mhm.
And so I'd love for you to spend some time today just really, breaking down what behavioral finance is and how important it is for one to understand their emotions, their ticks, their risk tolerance, and the way their behaviors really impact their finances overall. So, so let's just start with some softball questions. So, what exactly is behavioral finance?
I think it's really sort of the science behind making decisions, financial decisions, investment decisions, and really the whole behavioral finance has been around for decades now. I took a class on behavioral finance back in the 1990s. It was
Okay.
really suited towards professional asset managers, but it's become much more popular in the last 20 years. And one of my former colleagues and a good friend, Dr. Daniel Crosby, who was a chief behavioral officer at Orion, does fantastic work. And I think a lot of the literature has become a lot less academic and it's become a lot more accessible to investors. And why I think it's important, even for professional investors that are basically working with spreadsheets and screens all day, is that all of us have biases and preferences. All of us have emotional weaknesses. There's certain things about our decision making that we just need to be aware of what those biases and preferences are. I think as a professional investor, the more you know about behavioral finance, the better decisions you're going to make. But the same applies even to individual investors. I think just having an awareness of some of the ways that investors behave over time, it will create aha moments. It will create better conversations between investors and financial advisors. So I really think it makes better investment decisions. It makes better financial decisions to kind of know some of the ways that human beings behave with money over time.
Yeah, you see it all the time. When for us, right? I mean, we're using a lot of the same tools for all of our clients, right? Whether it's a spreadsheet, whether it's a financial simulator, a calculator, whatever it may be. But everyone's story is different, and everyone's ability to handle volatility, their their past, the way they've handled money in the past, the way they view money, is completely different. So every family we work with, it's a different story.
Mm-hmm.
And as an advisor, we have to always keep that in mind of, we can bring facts to the table, but if we're only bringing facts to the table and not emotions or not our clients' behaviors, there is always there can be a little bit of that disconnect, especially when there is expectations of performance. So why do you think it matters? Why do you think behavioral finance truly matters in the grand scheme of things?
Well, I think because the markets are essentially human, and I think a lot of people think that investing is all about spreadsheets and numbers, but it's really, again, it's really humans driving it. Even if there's algorithms out there, there's still a human being behind those as well. So I think an awareness of behavioral finance again leads to better decision making. Whether again you're a professional investor or you're an individual investor as well. There is a story of that Dr. Crosby talks about when it comes to behavioral finance, and he has lots of awesome stories. But when you do behavioral finance, you kind of understand again kind of the human aspect of decision making, but you also are able to hopefully understand your values and how that informs your investing as well. And he had an example, for instance, I always think this is a great example, that if you're making a big financial decision, if you have a picture of your family that you look at before you make that financial decision, you tend to make better financial decisions.
Wow.
Human quality that has nothing to do with a spreadsheet or numbers, but it's aligning your investing with your values.
I've never heard that story before. That makes total sense.
Yeah.
That makes complete sense. What's been the changes in the science of behavioral finance over these years?
Well, I think a lot of the principles have been in place for a while. I think the real improvement in behavioral finance in recent decades is that it's become, again, much more accessible,
Okay.
more easy to digest. I mean, some of those early papers back in the 90s, they could be pretty dense. I mean, you could ferret out the conclusions and spend some time with it, but now the material is so much simpler. And another thing about behavioral finance, there are a lot of tools that are really based on it. And
Okay.
again, leaning on the Orion experience, for instance, they have a lot of behavioral finance tools that an individual could take at their own discretion. And they could kind of understand a little bit more about their decision making, their risk tolerance, how they behave in different environments. So I think one, it's the information's easier to get to, and two, there's just more tools built on it. So it isn't just sort of this abstract theory. It's actually much more practical than it once was.
Yeah, when we do our risk tolerance questionnaire, our 3D profile for our clients, it's not your typical risk tolerance questionnaire where, on a scale of 1 to 10, tell me what kind of risk you're comfortable taking. I love the fact that it goes over the capacity. So how much risk can your plan actually afford to take? And then the tolerance, once, someone says they're a 7 out of a 10, then we actually put some numbers behind that and say, okay, well, if you're a 7, there's an expectation that your portfolio might have a drawdown of this percentage. Are you comfortable with that number? And when they actually see that number, when they see the drawdown, because what I've noticed, I've been in this industry for 21 years, is that when the market is hot, then and the market's humming, then everyone throws caution to the wind. Their risk tolerance is they're as risky as putting everything in Bitcoin, right? Because everything is going up. But once you see that little bit of volatility, then all of a sudden that gut check, that reality comes into play. So the reason why I like the 3D risk questionnaire that we do for our clients, which is different than I've seen in other firms, is that we can actually look at the capacity, but also take emotions and your behavior. Questions like, are you able to unleash things that are out of your control? Is that something that you focus on? And when you start having those questions and those type of conversations with the clients, I think the expectations that you've set good foundations and expectations of their plan and market performance.
Absolutely.
So obviously, I say obviously because every time you turn around, you hear the words or the letters AI, artificial intelligence is kind of taking over.
What's that?
What? It's taking over. There's like an AI mania. It doesn't remind me of the dot-com bubble, but I feel like when there's a new technology that is present, some people or smart people make, I'd say, dumb decisions with their money, right? I mean, if you're investing in anything that has the word AI in it, I think people are just gravitating and looking towards that. So do you think there is like this AI mania that's causing people to make decisions on their investments that they probably wouldn't have done in the past?
Well, you brought up the dot-com era and how it's different. And I think you're right. There are differences, very big differences. But I also think there are some similarities too. And I think it really drills down to the human psychology aspect of it, which has not changed. I mean, the only thing that's really changed between now and then is the headlines. And in the late 90s, it was the internet. Today, it's AI. But the underlying story is still the same. People see an exciting new technology that can transform the economy and society. But one of the big things, and I forget what this rule is called, but it is basically people overestimate the short-term impact of exciting new technologies, but they underestimate the long-term view. So what happens, they get excited in the short term, then FOMO kicks in, so the fear of missing out. Valuations tend to run far ahead of reality, and there's a lot of numbers right now that suggest that could be the case. And the truth is, AI is going to be big. It already is, just like the internet.
Right.
But again, a lot of these early players won't survive, and the same will likely be true here. I think that the dot-com era is still a good template to look at, but I think for investors moving forward, the key things are some of these principles that lead to good investing over time, such as discipline, diversification, and just patience, and try not let that FOMO kick in.
Well, what are your thoughts on? So you mentioned, the rise of internet, but I also see that there is a rise of social media influencers, on these different platforms where I think, some, at least for younger investors, that's where they're getting a lot of their information from, or they're getting their cues from on how to invest or how to view the market. How do you think that plays within a behavioral finance, right? I mean, are you seeing where the role of influencers are really playing a factor in investing?
That's a good question. I have a bunch of thoughts on this. So I guess social media, what it's done, it has democratized access to information, but you could also say it's done the same to misinformation. And you think about the old model of information, and it came from curated resources that had to protect their reputation, like the Wall Street Journal. But now, really, anybody with a phone or a following can influence investment behavior, and there's really no accountability. If they're wrong, they're wrong. If the Wall Street Journal was throwing out, stuff that wasn't high quality, it wouldn't be the Wall Street Journal, right?
Right.
But how that's impacted psychology is it's become much more about speed, being immediate. People want hot takes. They want quick wins. People want lottery tickets. There's a thrill being part of a crowd. But investing, again, it's going to go back to the fundamentals, the long-term success. It comes down to the principles of time in the market, and again, diversification and discipline. So I think social media can be useful for awareness, but I think it's dangerous if it replaces a sound investment process. And one other thought, I think it is clearly impacting investor behavior. You did talk about it. It's a lot of the younger investors. So that's not really kind of the big money in the marketplace. It's influencing certain segments.
Okay.
So I'm not saying that's the reason why maybe the overall market is at these high valuations right now. That's probably just a bigger narrative. Again, we've already talked about AI.
Well, you speak about the valuations in the markets. I mean, do you think there is some level of disconnect between the how expensive I feel like the market is in relation to what old school investing is, where people would actually look at value, would actually look at price to earnings, and look at a fair multiple, but some of these companies are trading at multiples that we've never seen before. Is there some form of like fear of missing out, or do you feel like there is some validity to where the market stands right now?
I'll go with kind of yes to all the above. So, so first of all, valuations. There are some valuation measures we're at all-time highs as
Yeah.
we're recording this, and how can that not give you some pause? Now, so again, I think that comes back to, I mean, my mantra is stay invested, stay diversified, stay disciplined. And I think when the market has these kind of valuations, that those three bullet points still remain the same, but the diversification angle is as important as ever. Now, I do think there's a reason why valuations are higher than long-term averages, and there are good reasons for it. I mean, transaction costs are lower, taxes are lower, information costs are lower, interest rates compared to long-term averages are still lower. All these things would suggest that you should have higher valuations. I also think another thing is, it kind of is related to the information side, is once upon a time when it came to making decisions in the market, it kind of came down to the old school approach of you had a broker, and he or she, for them to get paid, they needed transactions, right? So now financial advisors have a different model, and they're basically trying to, and rightfully so, slow people down, not react to headlines, not react to the news flow. And I think because investors, primarily through financial advisors, are steadier than they have been in the past, I think that also, all else being equal, would make valuations a little higher. So when people talk about how valuations are like X percentage off their long-term averages, maybe that's a little sensational, but I'd say there is still truth. The market is still, by some metrics, the U.S. market, really like the S&P 500,
Yeah.
is at its most expensive levels ever. Hope that made sense.
That makes total sense. It makes total sense. That makes total sense. Well, the way I'm trying to tie it into it is, well, the market is, we're at all-time highs in certain areas. How client-facing are you right now? Like, do you still see clients at all, or are we your clients, or financial advisors your clients?
I have, my career my clients have been everything. They've been clients from back when I worked at Fidelity Investments and FMR Co. My clients were portfolio managers. And then it was individual investors at my next firm. And then it's been financial advisors. So my clients are primarily financial advisors,
Okay.
but I do talk to a lot of individual investors on behalf of those financial advisors.
Okay. The reason I bring that up is because the markets are at where they are, the levels as they are right now as we're recording. Even as recent as yesterday, had a client ask me, "Is this a good time to invest because the market is high?" And, I go back to the behavioral finance, right? I mean, if you think about the old adage, buy low, sell high. Well, right now the market's on, it's on fire. So is this a good time for someone to buy? And I'm not putting you on the spot to make any recommendations. Someone says that, as far as, is this a good time to buy? What does that mean about their behavior? Does it mean that sometimes they're just trying to catch the waves, or does that make any sense as far as like how does that impact their decision making?
A couple of thoughts on it. First of all, I think it's always a great question for any investor to ask their advisor, even if they kind of know what that answer should be, because you're testing the advisor in the situation to
Yeah.
see what their philosophy is. And I think the answer is, as you know, in that situation, is it always depends. I mean, it always depends. It depends on the goals. It depends on the risk tolerance. It depends on the investor. I mean, the market conditions, I do think, can impact it, but it so depends. The answer could be, heck yeah, this is an awesome time to buy. Or it could be, for instance, let's say you have, an older investor who, has a chance of running out of money and they're already overinvested to the stock market. Maybe that's a situation you take something off. But let's say you have a 20-year-old investor who is like 30% invested in the stock market. They should be buying. It all depends on the individual situation. And again, that's the reason why investors should be working with advisors, kind of walk through those scenarios and understand when is a good time to buy.
Mm-hmm. Yeah, no, I think that's because, working with someone, an advisor, you have that accountability partner, but you have that person that also can, sometimes play psychologist and, talk you off the ledges and really bring some context and layers behind where the markets are going and making sure that you're making the right decisions for your long-term goals. And in some aspects, taking, the emotions out of it just to make sure that you're making the right decision. Well, right now, there is a lot of politics that are going into, I'd say, the markets and in portfolios. So how does politics or one's political view in your history play within their behavioral actions when it comes to their finances?
Well, let me use an analogy here real fast. So as we're recording this is at the beginning of September. So it is fantasy football season.
It is. It is.
And so maybe a lot of people on here have recently had drafts. And I'm a huge college football fan, and I do watch the NFL, but I don't really have any teams or any favorites. I mean, yeah, maybe I have some favorites, but when it comes to fantasy football, I have tended to do pretty well. And I'm not trying to brag or anything, but I'm saying the reason why that I've tended to do well at these games is that once you're playing somebody in fantasy football, and even if they are the most knowledgeable person on the sport and the teams, once they start picking favorite players or favorite teams, they're being suboptimal in their decision making. They're being suboptimal. So once you bring in favoritism, once you bring in some emotion, you are going to create suboptimal decisions. Now that's just in fantasy football. Now let's take it to politics. And I would say our political environment right now is, pretty agitated. I mean, people feel pretty strongly on both sides. And that, likely does inform a lot of people's decision making in their portfolios. And once you're just getting emotional like that, and you're not really focusing on the facts we talked about earlier, such as what are your goals, what are your risk tolerance, what are your other unique considerations as an individual investor. But once you start sub-optimizing by using emotional factors, the data bears it out. It's, people on the left, if they're just voting on kind of left issues, tend to underperform. People on the right are only voting on the right issues, tend to underperform. But the people who stay invested outperform both over time. And again, it's because you're minimizing those emotional biases.
That is a great analogy. That really is. Can I steal that?
Yeah, now you can win fantasy football.
I've won my league once in the last 7 years, so maybe I need to be less biased with my Florida Gators, and I just pick Florida Gator players. So
see, there you go. Right after that. Hey, they're great, and they got great players, but
a couple of more questions before we wrap up, and thank you again for your time. I really, really do appreciate it. What I am interested in is, over the last few years, we've seen like the value of homes just skyrocket and increase and almost double over the last few years. 401ks are at all-time highs, but you hear about inflation, and you hear about the cost of just your day-to-day living that people are being impacted with. So what's happening psychologically, if you can speak on it, when your paper wealth doesn't really translate to your everyday wealth or you feeling wealthy? Is there any psychology behind that?
Oh, I'd say that there is. I mean, it probably for most Americans, they definitely feel like there's a gap between their wealth on paper and their cash flow in real life. And, markets and housing prices are up, but it's the everyday expenses, the food, the energy, healthcare, they're higher. And all else equal, that's going to make people feel squeezed. I mean, inflation right now is running higher than it has been. Well, obviously after COVID, it ran hotter. But if you go back the last 20, 30 years, inflation right now is running a little bit higher. And then when you kind of look at the everyday expenses, they're also running a little bit higher too. And one thing that's a little deceptive about saying all those numbers is that if you look at, usually they're talking about inflation as year over year, but if you think about inflation, if you like 3 years over 3 years or 5 years over 5 years, it's clearly elevated. And so psychologically, people can just feel that. Portfolios might be growing, but the daily expenses are also growing. And I think the key to kind of separate the short-term discomfort is from the long-term growth in your portfolio. So I always think a really good line here is, financial security is built over decades, not at checkout time when it comes to portfolios.
Say it again.
But I do think
financial security is built over decades, not checkout lines.
Yeah, financial security is built over decades, not at the checkout line.
I like that.
That's kind of just talking about what's going on out there. But I think inflation is something that is, people are feeling it. They're probably underappreciating it in portfolios to a certain extent. And probably it's just a function of my age. But when I started off in the industry and when I was in college, we were studying the experience from the Nifty 50 era in the 1970s. And it was just drilled in our heads constantly that the return that was important, it wasn't just after tax, but it was also after inflation. And I kind of feel all else being equal. I think a lot of people get obviously the after tax stuff, and our industry has done so much better on that in recent years, even thanks to tools like direct indexing and whatnot. But I think the after inflation stuff is still underappreciated. And you can tell that in the way people are building portfolios or what they're expecting from the bond market or whatever it is. So I think that is still one of the key factors in making investment decisions, is somehow baking in sort of that inflation protection.
Yeah, I totally agree. And you're right. There is a lot of spotlight on after-tax performance, after-tax returns. But at the end of the day, if you're not factoring in inflation, and especially long-term planning around inflation, then you may be just missing the mark, because obviously we know your spending power gets eroded with inflation. So you're right. I think there is more talk about the after tax than after inflation.
Hey, don't tell me after tax is crucial too.
Oh, it is crucial.
Yeah. The advisors, they can add alpha in so many different ways, and there's so many different technical ways, but just simply put, an advisor who is really kind of focusing on those after-tax returns, that right there pays for advisor fees. Never mind all the other stuff that financial advisors are doing. So that's important.
Yeah.
But you're right. After inflation is also important, particularly in an environment, as we're recording this, inflation hasn't been slayed. And if anything, it looks like it could be rising again. Not necessarily to the levels of COVID, but it's not going back to 2% in the near term. It's just kind of the way the numbers flow right now. And there's probably seems like more of a risk it could get to 4% than 2%. So how are portfolios prepared for that?
Well, if you think we're not going back to 2% anytime soon, at least, the 2%, the 3% mortgage rates, which people thought were still too high back then, right? They wanted to get, when interest rates when interest rates were at zero, right? You had mortgage rates at 2.75, 3%, and people were still looking for it to get lower. Now it's 6.5%, 7% is like your new norm. Okay, and I don't know about you, but I'm still hearing people waiting for the rates to drop, and not moving forward in either purchasing a home or selling a home because they're waiting for the rates to drop. They're waiting to get back to some era, some time. What do you say to the person that's waiting for the past to come back when when it doesn't even look like we're heading to that future? We're not heading to that past anytime soon.
Well, I think kind of in my role as, one of the many roles, just being an educator. And I think the issue you're talking about, which I hear as well, is really a case of just a classic anchoring. And people are just looking at the recent past. And just an easy thing to do is just look at the history of the markets and the economy and just take a longer term view. So I think a really good chart right now is when it comes to interest rates, look at the last 50 years, look at the last or 60 years, a chart like that. And at that point, I think in terms of expectations for interest rates, you see that interest rates are still below the long-term average going back that long. And if anything is unique, if anything is extraordinary, if anything is sort of out of line with the history, it was when interest rates were so low. That was the exception, not the rule.
Mm,
And so I think you look at the history, it kind of resets the anchor, resets the expectations as well.
I agree. Practically, what are maybe two or three practical principles or disciplines that one can use, one can remember when it comes to making good financial decisions and not being too emotional about it?
I have three.
Three.
So
Okay.
that's great. So I think the first thing is, and again, this works for the individual investor, and again, this works for the professional investor. It's just write down your plan.
Okay.
If you don't have a plan, you're going to default to emotions or, intuition. And sometimes intuition can work, but a lot of times it doesn't work. So you need the discipline of a plan. And the second thing is, and again, there's a lot of this going on in our economy now, which is great, and that is automate whatever you can. And we're
Mm,
talking contributions, rebalancing, savings. Again, you're taking the emotions out of the equation. It's adding that discipline. And then the third thing is surround yourself with accountability. And again, the plan's part of it, or a written checklist could be part of it. A spouse could be part of it. But again, sometimes you need that outside accountability partner, and that's the financial advisor. Again, it's discipline, the ultimate edge, and all of these help. Discipline helps versus the emotion. It's easier said than done, but at least it gives you a better fighting chance to make better investment and financial decisions.
I love it. I love it. Have a plan, stick to it, automate, just make it easy. Make saving easy, make investing easy. You rebalance. That's huge. I see when clients first come into our office and we ask about their portfolios, and I may ask a question of when's the last time you looked at your portfolio? When is the last time you made any changes to it? Sometimes you get the deer in the headlight looks because they haven't really made any changes at all. So rebalancing is huge, and I love it. The accountability.
Yeah.
Someone who can keep you honest, but also that you can talk to, and someone that you can toss ideas around and just make sure that you are like I said, taking the emotions out of it and thinking through it. That's awesome. Any last notes? I mean, anything else that we should know about behavioral finance and how it can impact one's long-term, short-term goals?
If for some reason somebody has not read anything on it, again, there's a lot of great text out there. I've already mentioned one author, Dr. Daniel Crosby. In fact, his last book, The Soul of Wealth, and I think I've recommended this so many times, he should be paying me on it now. But the Soul of Wealth is 50 short essays. You could read it on an airplane ride, but you don't want to. You should just read one at a time, maybe before you go to sleep at night. Just let it sink in. And also, I actually read chapters with my wife. We'll
Really?
read them together, and then we'll kind of talk through the issues that were talked about. I think it's really cool. It strengthens, our partnership. And so that's one. There's other great authors. Morgan Housel has written some great books. Those are very accessible and just helps you start thinking about things. And I think if you just read those, it will help make financial decisions a little bit better.
Okay. All right. Well, thank you. Thank you. We'll put the links to those. I have read some of Soul of Wealth. I do have it. I haven't read all of it, but I did read. Oh my gosh, what's his book before Soul of Wealth?
Well, Behavioral Investor, which is great.
No, it was. Oh my gosh, what was Cross Daniel's last book before that? I have it in
Well,
the office. My goodness, and we did a
I know
we did
you
a
got me
whole.
on the spot too, Blake, and I can see the title. I mean, I can see the
I
cover.
mean, we literally did a book study on it.
Well, the nice thing is when people listening to this, they're going to see it in the show
They're gonna see
notes.
in the show notes. Oh my gosh, Dr. Crosby, I apologize. And you have a podcast too. Before we let you go, let's talk about
Oh,
your
I do.
podcast.
Thanks. Yep. So I've hosted over 300 podcasts in my career. A lot of them, of course, with Orion. But I have launched a new one. It's called Invest Well, Be Well,
Okay.
and really, it's about stronger. It's about wiser investing and stronger living. So basically, we talk about kind of long-term investing principles and mindsets. And then we usually go into the back half. Well, not usually, we always do. In the back half, we kind of go into personal practices, how these various investment professionals sort of maintain their performance, their energy, and whatever it is to make sure they're performing at their highest level, both professionally and personally. So I also have a blog out. It's rustysbridge.com. It has the links to the podcast, and it also usually maybe 2 to 4 times a week, I'll have like a quick 2 to 3 minute read on it, on something. So
Awesome.
that's
Awesome.
bridge.com.
Well, congratulations on
Good.
the new position, on the podcast, on the blog. We'll put links to both at in the show notes. But again, thank you, Rusty, for your time today, and we'll see everyone next week.
Thank you, Mo.
Thank you.
Thanks,